You're in the right place if you're going to invest your money into stock market returns in 2025. Today, I would like to share with you some of the most outstanding index funds and ETFs that I genuinely believe one should consider adding to their portfolio. From veteran investors to those just starting to grapple with their investment journey, this session is for all of you. Now, you know that I am not a BSer. I am here to give you the speaking the gospel truth about investing. No fluff, no hype, just practical strategies and insights that you can actually use. And trust me, I've been through all the ups and downs of the market, so I know what works and what doesn't. In this video, we talk about the importance of index funds and ETFs as absolute game changers for investing your money. Here, we're going to break down their pros and cons, and then I will give you personalized recommendations that can help you forge ahead into constructing a rock-solid investment plan for 2025 and beyond. So, grab a cup of coffee, get comfy, and let's dive into the world of index funds and ETFs. It's going to be exciting, I promise. Alright, let's talk about why index funds and ETFs are absolute must-haves for anyone investing in the stock market. Above all, they're easy, cheap, and vastly powerful. Consider them the next step in the set it and forget it strategy. You don't need to be a financial genius, you don't need to spend hours researching companies, and most importantly, no stress. Once you've invested, the funds do the work for you. It's that easy. Warren Buffett. Yes, the Oracle of Omaha himself. He said it many times. Most investors, both small and large, are better off sticking with index funds. And let me tell you, he's got the receipts to back it up. Here's a quick story for you. Back in 2007, Buffett made a $1 million wager. He wagered a New York City hedge fund manager that an S&P 500 index fund would consistently beat 5 hand-picked hedge funds over a period of 10 years. The bet went on from 2008 until 2017, and let me tell you, hypnotic. The hedge funds, they have achieved a 36% cumulative return over 10 years. That's around 3.6% per year, not spectacular. On the other hand, what about Buffett's bet, that modest Vanguard S&P 500 index fund? It crushed it with a 125% return. That's a whopping 12.5% per year. All you need to do is make it easy to manage, keep it cheap, and let the market take you from there, over time. Observe, the advantage of index funds and ETFs is that not only don't you have to win the market, you also become the market. And over the long haul, that's a winning strategy. Since you now understand why index funds and ETFs are great, now let's look into the pros and cons to see if they're the right choice for you. Spoiler alert, they're probably one of the smartest choices you can make, but hey, let's break it down. First up, the pros. Low cost and easy management. Index funds and ETFs are some of the cheapest investment options out there. You're not paying crazy fees to fund managers, and the maintenance? Practically zero. Once you invest, you can just sit back and relax. Reliable market-matching returns. This is the real beauty of it. If the stock market grows 10% in a year, guess what? Your investment grows by 10% too. You don't have to stress about whether you're picking the right stocks. You're literally riding the wave of the entire market. Long-term potential with less stress. Investing can be intimidating, but index funds and ETFs treat it like a walk in the park. They're perfect for people who want solid growth over time without the anxiety of constantly watching the market. Now, let's be real, there are a few downsides you should know about. You won't beat the market. If you're chasing quick riches or hoping to double your money overnight, this isn't your strategy. Index funds and ETFs are only for mirroring the market, not winning the market. Not ideal for thrill seekers. If you're someone who loves the high-stakes game of stock picking or enjoys the roller coaster of high volatility, you might find index funds and ETFs, well, boring. They're predictable, steady, and that's kind of the point. However, the trade-off of the pros outweighs the cons, especially if one wants to create wealth over time with minimal effort. And honestly, isn't that the goal? Consistency over chaos, growth over guesswork. Now, let's get to the heart of the matter. The S&P 500. This is the heavyweight fighter of the stock market, the one following the 500 largest companies in the U.S. We're talking about giants like Apple, Microsoft, and Amazon. In essence, if you need a strong base for your portfolio, the S&P 500 is just that. It's diversified, it's consistent, and it's been producing phenomenal returns for decades, etc. Index funds and ETFs. Let's start with some of the top index funds. First on the list is the Vanguard 500 Index Fund Admiral Shares, or VFIAX for short. This fund is a legend. It was founded back in 1976, literally the pioneer of index funds. With this endowment, you'll have exposure to the 500 largest U.S. businesses, providing you with a piece of the whole economy. And the best part? Vanguard has a reputation for low fees, so your money stays in your pocket longer in the long run. It's a fan favorite for good reason. Then Fidelity 500 Index Fund, or FXAIX, has been presented to the consumer. This one is fantastic because there's no minimum investment, zero. That makes it super accessible for everyone, whether you're starting with $100 or $10,000. Fidelity is also known for its user-friendly platform, so if you're just dipping your toes into investing, this is a great option to consider. Finally, let's talk about the Schwab S&P 500 Index Fund, or SWPPX. This is a rock star since it's one of the lowest expense ratio S&P 500 funds around, with an expense ratio of 0.02% fee. That's right, 2 pennies for every $100 invested. It's hard to beat that level of affordability. And like Fidelity, there's no minimum investment, so it's perfect for beginners and seasoned investors alike. Now, let's talk about performance. In the years past, this money has generated consistent, predictable growth that has been virtually a pure match to the S&P 500. Historically, the S&P 500 has returned about 8 to 10% annually, and these funds have done an incredible job of tracking that. If you're looking for a long-term investment to grow your wealth, these index funds are excellent choices. Now, let's shift gears and talk about ETFs, exchange-traded funds. These are akin to index funds, but on the open market they can be bought and sold as individual stocks. That means you can buy and sell them throughout the day, just like you would with any other stock. If your brokerage doesn't have index funds and you want more choice, ETFs are a great alternative. Here are the top picks for S&P 500 ETFs. The next one is the SPDR S&P 500 ETF Trust, or SPY. This is the daddy of ETFs, the first ETF ever to come to market in 1993. It is also the biggest U.S. exchange-traded fund, ETF, with an enormous amount of assets held under management. SPY is extremely liquid, i.e., it can be bought or sold in seconds. It is so well established, reliable, and ideal for someone desiring convenient, safe access to the S&P 500. The only downside? It's a little pricier than some other options, with an expense ratio of 0.0945%. That's about 94 cents for every $1,000 invested. Then it is the iShares Core S&P 500 ETF, or IVV. This one is a bit of a hidden gem. It's nearly identical to SPY in terms of exposure to the S&P 500, but the twist is it has a lower expense ratio. IVV costs only 0.03% annual rate, i.e., 30 cents of every dollar invested. If you're planning to buy and hold for the long term, IVV might be a better option for you because those savings on fees can really add up over time. At last, the Vanguard S&P 500 ETF, or VOO, is available. Vanguard strikes again with another low-cost, high-quality option. Similar to IVV, VOO also features a break-even expense ratio of 0.03%, and it replicates the same index with similar performance. The main difference between IVV and VOO comes down to your preference in brokerage and brand loyalty. But honestly, you can't go wrong with either one. So, there you have it, 3 top-notch ETFs for S&P 500 exposure. SPY is the deepest and oldest of the 3, while IVV and VOO are great low-cost funds for long-term investors. Win, lose, or draw, regardless of which one you select, you will be on top of the U.S. economic wave and positioned for success. No matter if you adopt an index fund or an ETF, the S&P 500 is a good option to help construct a robust, diversified base of your portfolio. Trust me, you'll thank yourself in the years to come. Now, let's say you're looking to go beyond the broad market. Maybe you're interested in a particular area of the economy, like energy, technology, or even international markets. Well, good news. There are industry-specific index funds and ETFs that are created for those specific industries, etc., etc. They leave you free to concentrate on the verticals or areas that you think will be successful in the future. Let's take a closer look at some popular options. If you're bullish on energy, think oil, gas, and energy services, then the Energy Select Sector SPDR Fund, or XLE, is a great pick. This ETF gives you exposure to the biggest energy companies in the S&P 500, like ExxonMobil and Chevron. It is ideal for people who expect prices or demand for energy will increase. Keep in mind, though, that the energy sector can be a bit volatile. It has its highs and lows, but if you time it right, the rewards can be significant. Now, it is the turn of the Vanguard Total International Stock Index Fund, or VTIAX. This is a text about entry to markets other than the U.S. market. It offers access to developed ones such as Europe and the Pacific, and to developing ones such as Asia and Latin America. If you stay positive, international economies will catch up to the U.S. over the next few years. This fund will be a great option to gain exposure to global markets. Just keep in mind that international markets have their own risks, for example, currency changes, geopolitical events. 1. Now, if you're more focused on fast-growing economies, the Schwab Emerging Markets Equity ETF, or SCHE, is a fantastic choice. This fund gives you access to markets like Brazil, India, Taiwan, and China, places where economic growth is booming. Emerging markets can be a roller coaster ride, though. The potential for high returns is there, but so is the risk of volatility. It's a good investment for people who are ready to die a little bit more to possibly die more, etc. And last, but not least, the tech. Who doesn't love a fun innovation on the team? The Invesco QQQ, also QQQ, follows the Nasdaq and contains many of the leading technology companies, such as Apple, Microsoft, and Tesla. It's one of the most traded ETFs in the market, and for a good reason. Tech has been a market force for decades, and this ETF provides you an inside seat at the show. Moreover, the track record of QQQ performance has shown it to beat the performance of most other funds, although with a degree of volatility. One thing to keep in mind, sector-specific funds are, by nature, more volatile than broad-based index funds or ETFs. That is because they are linked to the productivity of one industry or a particular region and themselves are capable of changing significantly in reaction to changes in global economic conditions. But if you're confident in your outlook and willing to ride out the bumps, they can be a fantastic way to target growth in specific area. Whether it's energy, international stocks, emerging markets, or tech, there's a sector-specific ETF or index fund for just about every investment theme. Imagine them as a tool to customize your PAN portfolio and to match your opinions about what the market will look like in the future. Just be sure to balance these with a broader strategy to keep your investments on solid ground. In the short term, the market might have its ups and downs. It's just the nature of investing. But over the long term, S&P 500 index funds have provided a solid core investment. They're designed for scale, stability, and repeatability. That's why they've withstood the test of time. The best part: investing in these funds is so straightforward. Skills are not needed, nor is any ongoing management required. It's a pure set-it-and-forget-it approach. You invest, and then you let the market do its thing while you focus on living your life. It's low stress, low effort, and incredibly effective. If you enjoyed this video or found it helpful, please give it a thumbs up, subscribe to the channel, and share it with anyone you think might benefit. Your support means the world to me. Until next time, happy investing, and I wish you a wonderful day. Take care.